Hello everyone. So I am here with part 2 of chapter number 9. As I said, that together it becomes a little longer, but I wanted to just break it up into two. So here we go. So the main point that we are making in this portion of the chapter is to show you the details of income manipulation under absorption costing. So we are going to kind of put variable costing on the backstage. Remember, in part 1, mainly we learned that there are two methods of inventory costing. One is absorption costing and one is variable costing. Absorption costing is the only gap approved method, although variable costing is better for decision making purposes. And there are many manipulations which are possible under absorption costing. So we are going to try to get into the details of those manipulations under absorption costing. So here we go. So first of all, let us try to understand what capacity means. Okay, we have been talking about capacity in the context of fixed overhead in chapter number 8 also, but capacity essentially means what is the maximum amount of units a company can produce, okay, within reasonable restrictions. Okay, so I'm going to show you the practical use of capacity in the calculations very soon, but let's go through the theoretical meaning of what is happening. Capacity assumptions, meaning how much is the company's capacity, can help you determine what would be the income in absorption costing. Okay, you can hold it on back burner, but I'll talk about different type of capacity assumptions soon. Okay, so as you can see again, capacity is related to the fixed overhead costs of the company. For example, if I'm talking about a factory, okay, and my factory has a capacity of making 1 million units, but I'm currently making only, let's say, 500,000, then I'm hugely over capacity and I'm spending a lot of money in setting up a factory of that size, okay, which I'm not using, at least currently. Okay, so we will talk about that. Okay, essentially we will talk about 4 type of capacity levels here: theoretical, practical, normal, and master budget. I'm going to define each one of them, and then we will calculate income under each of these methods. That's the job at hand. Okay, you will also see that companies use these 4 definitions strategically because income calculation under each method turns out to be different. Okay, once again, we have talked about this in part 1. The income calculation under absorption costing is different whenever production is different from sale. If production is exactly equal to sale, then no manipulation is possible because you have to take all the fixed cost into your cost of goods sold. But whenever production is bigger than sale, okay, you can take a portion of your fixed cost into the inventory, and that's where the manipulations begin. Okay, now let us first define the 4 capacities before we go into the numerical problem. Theoretical capacity is the maximum possible output a company can make. It's almost like saying, if you have an exam tomorrow, how much theoretically can you study today? Well, theoretically, you have 24 hours. So your theoretical capacity is 24 hours, but I'm sure you're already laughing because it's not practical for anyone to study all 24 hours. Similarly, for companies, it is more practical to allow for bathroom breaks, for shift change, for machine breakdowns, for repair maintenance, power outage, okay, material shortage. All kind of things can happen, because of which practical is going to be smaller than theoretical capacity. Okay, so theoretically you could study 24 hours, but practically, if you were to kind of allow small amount of sleep, food, rest, etc., maybe you will say, let's say 14 hours. Okay, 14 hours can be done. I have done it. Okay, Normal capacity says what is your average. For example, on an average, how much have you been studying the last week? Okay. So in manufacturing setting, normal means on an average, how much have you been producing in the last 3 years, 5 years, 10 years, whatever. Okay. So it is a much more sort of stable number from the company's point of view, but typically smaller than practical number. Finally, the last and the closest to your for master budget forecast number is the number that you are likely to produce in the current period, in the upcoming period, that is. Okay. So if my current production forecast is that I'm going to produce 10,000 units, then that is basically my current capacity, no matter what my theoretical capacity is. Okay. So the first job in these type of numerical questions is to read the paragraph and decide which one is theoretical capacity, which one is practical capacity, etc., etc. Not hard, but question is there. Okay. Let us now try to look at some data so that we can start solving. We are given that there is a company, we can talk about a furniture company again, doesn't matter. Fixed manufacturing overhead dollar amount is 120,000. That's the main star of the show today. Okay. Variable cost per unit is $20. Okay. Company has produced 8,500 units, although they have sold only 8,000, meaning production is still bigger than sale. Okay. Ending inventory as a result, clearly 500 units. Okay. They're selling each unit at $50. Okay. Now you are given 4 different type of capacities. Okay. As you can see, they are on a sliding scale. Theoretical capacity is the maximum possible, practical a little smaller, normal smaller than that, and master budget, the amount that I'm likely to produce, okay, is the number here, even though I actually ended up producing different, but these are the 4 capacities I was given in the question. Okay. So given these questions and given the data, okay, how to calculate operating income under each of these methods is basically the job we have at hand. Okay. All right. So let us get into it. So I just copied these 2 numbers that I'm going to require. The 2 type of costs that I was given on the previous slide was manufacturing overhead, $120,000, and variable manufacturing cost, $20 per unit. Now, first thing we do is to calculate budgeted overhead rate. Okay. Remember, I have to spread my fixed cost over all the units. In this case, what am I going to do? I am going to take my fixed cost and I'm going to divide by each of the 4 capacities that I was given. Okay. So if I divide 120,000 by 12,000, I get $10 per unit of budgeted rate. On the other hand, if I divide the same fixed overhead by 8,000 units in my master budget, I will come up with $15 of rate. Now you can see the smaller the denominator, okay, the bigger the rate. Okay. So the rate here is the biggest because you're dividing by the smallest denominator. Okay. So this is the first step every time you are talking about calculating income, is to figure out the fixed overhead rate. Okay. Now you're going to add your fixed overhead to the variable cost, which is given to you at $20 per unit. So for each of the methods, these are the numbers that you have created for fixed overhead. You combine that with the variable overhead, and this is your per unit product cost. Okay. Under each of the 4 capacities, your per unit cost is already turning out to be different. Why? Your assumption about fixed cost is the same, but your assumption about the denominator, the one that you use to divide your fixed cost by, is different. Therefore, your per unit cost is different. Okay. Everybody okay? Let's go to the next step. I just copied some of the information below here and the calculations we did on the previous page so that you can remember our per unit cost under each capacity so that we can do cost of goods manufactured. Now, I simply take the number of units that I have manufactured given to me in the question and I multiplied by each of the four numbers. And I say, this is my cost of goods manufactured under each situation. So clearly, if my per unit cost is different, okay, each method is going to give me a different cost of goods manufactured. Similarly, it is going to give me different value of inventory. Given that I produced 85, but I sold 8,000, I have 500 units in my ending inventory. So for 500 units, combining with these costs, I have the value of ending inventory. If you remember, when we make the finished goods inventory account, we have cost of goods manufactured here, which splits itself into two. Either the goods get sold, in which case the cost goes to cost of goods sold, or the goods don't get sold, in which case the goods are in the ending inventory, right? So we have 8,500 units in cost of goods manufactured right here, right? Out of which 500 are still in my ending inventory, which means 8,000 units, okay, are in my cost of goods sold, right? That's what I'm given in actual sales. So now I need to calculate the value of cost of goods sold. Remember, I am heading towards making an income statement absorption costing type. In order to make an income statement, I need cost of goods sold. So that's my third step. Okay. Once again, okay, I can either subtract cost of goods manufactured minus ending inventory, or I can simply say 8,000 units in cost of goods sold, okay, multiplied by these four costs, and so on, I will get these numbers. Okay, everybody clear how we got cost of goods sold? It is basically number of units sold multiplied by the product cost per unit under each capacity assumption. You with me? Okay, let's go to the next step. Okay, this is a crucial step. You have seen it in chapter number 8, but I'm going to give you some background to the information that we have calculated. This one we have already calculated as your fixed cost per unit. Okay, this is your value of cost of goods sold that we calculated on the previous slide. Okay. Fixed manufacturing overhead was given to you as 120,000, which is also here, but just to kind of make sure that you know these numbers were given. Okay. Now what do? We are saying that for each type of capacity, okay, company has to apply the overhead. You have seen this in chapter number 4. You have also seen this in chapter number 8, that companies typically make these budgeted overhead calculations before the year begins, and they apply overhead throughout the year. Okay. How is the overhead applied? The number of units, okay, that you are actually producing, okay, you take them actual production and you multiply it by your overhead rate, and you keep multiplying. Okay, so this is your applied fixed overhead. However, at the end of the year, actual overhead will come out, and the auditor is not going to let you have an estimated overhead in the books. We have talked about this in chapter number 4 when we were doing job costing. So we will have to make an adjustment to cost of goods sold. Okay, if we applied too little, we'll have to add it to cost of goods sold. If we applied too much, we'll have to subtract it from cost of goods sold. Okay, you have seen the same calculation very recently in chapter number 8, where we talked about volume variance or production volume variance, okay, as a difference between applied overhead and budgeted overhead. So that's what we are doing. We are taking this applied overhead from this column, okay, and we are subtracting the budgeted overhead from each one of them to calculate volume variance or production volume variance, as you call it. Okay, so here we have applied too little. Okay, so this is U unfavorable, or you can call it under applied also. Okay, if you recall in chapter 4, we used to say actual is here and applied is here. If applied is 85 and actual is 120, then you need to put 35 on this side to close this account. Okay, meaning you applied too little. So Here it's U or underapplied, as the case may be. How do you decide what is underapplied or overapplied? Whenever actual production is bigger, okay, than budgeted production, okay, then it is favorable or overapplied, otherwise it's underapplied. Okay, let's keep talking about it. Okay, the first three are unfavorable because you have underapplied. Here you have overapplied because your rate was so high, okay, that what you applied is more than what your budgeted for fixed overhead was. For the purpose of convenience, in this chapter, we assume that our actual overhead turns out to be exactly equal to budgeted for fixed overhead, so that we don't have too many overhead numbers floating around. Okay, so one is favorable, three are unfavorable. Now we have to make this adjustment to cost of goods sold so that we can be ready for income statement. Okay, so we say our unadjusted cost of goods sold that we calculated on the previous page, we copy here. Now we take these adjustments for our production volume variance. Okay, and notice whenever it is underapplied, we add. When it is overapplied, we subtract. Okay, so now this is my adjusted cost of goods sold. Everybody with me? All unadjusted cost of goods sold has to be adjusted up or down with the underapplied or overapplied overhead. Underapplied overhead is also called unfavorable. Overapplied is also called favorable. Underapplied means add. Overapplied means subtract. So that's what we have done. Now we are ready with our adjusted cost of goods sold, and we go to the income statement. So I'm just copying the numbers that we just calculated on the previous slide, plus time has come to make the income statement. So I need my sales revenue information, which I also copied from the question, and I'm ready to calculate my income. As I said before, there are no operating expenses given in this question. So gross profit is the same thing as operating income. Okay, so sales revenue, this multiplied by this, sales revenue remains the same. It doesn't matter which capacity you are talking about. It is only your cost of goods sold, which is different under the four methods. And then you can see that your income, okay, is rising slowly. Income is the smallest here. Income is the biggest here, which means smaller the denominator you use. And FASB GAAP allows you to use any denominator you want. There are no rules on what denominator you should use. The smaller the denominator you use, the larger is likely to be your reported income. It's quite a magical thing, but it is true and it is legal. Okay. Now let us look at the impact of inventory very briefly, because right now we are looking at cost of goods sold's impact on gross profit. Now let's look at the value of inventory. I'm going to clean this one up a little bit. Okay, what is happening here? Remember, I had 500 units in inventory. Okay, for each one of them, I had the product cost per unit, and this was the value of my ending inventory. Again, you can see higher the value of ending inventory, okay, higher is my income. So if I put a lot of production into ending inventory, then a lot of my fixed cost is getting transferred into ending inventory, meaning my cost of goods sold is going to look leaner, meaning my income is going to look higher. So higher value of inventory also leads to higher reported income, is what this slide is trying to show you. Okay. Now I have the summary of the whole chapter here for you. Okay. Step number 1, you calculate fixed overhead rate. Step number 2, you calculate applied overhead. Step number 3, you calculate volume variance. Then you adjust your cost of goods sold either up or down with the adjustment from volume variance. And finally, you calculate gross profit. Okay. So absorption costing is the only one in which this can be done. And this kind of manipulation can be done if the difference between production and sale is very high. So higher the difference between production and sale, Okay, higher is likely to be the difference between absorption costing and variable costing income. Okay, so that's basically the point. How to calculate operating and income under each methods is what we wanted to discuss here. Okay, all right, we'll discuss more deeply in class, but these are the basic concepts. All right, guys, have a great day. I'll see you soon.